You familiar with using life insurance as like a banking system?
I wasn't until I found out about you. And so that is exactly why I
Okay.
wanted to have you on today because yeah, please explain that to us. I thought it was so fascinating.
Yes. So basically, what we're looking at is so there's a very specific type of life insurance to use. It's called high early cash value dividend paying whole life insurance. That's a mouthful. I just call it the sacred account. And that's basically what that means. But it's basically you set up a life insurance policy where you can contribute funds, and the money that you put into it goes directly into a cash savings account. Those are going to grow typically at about a 3 to 5% annual rate. So it's much higher than what you're going to get at the bank. It's guaranteed against loss. It's guaranteed to grow. It's protected from taxation. It's protected from creditors, lawsuits. It's protected from a privacy standpoint. It's what's known as a unilateral contract, meaning if I put money in, I'm the only party that can touch or access that contract. So it's a very safe place to put money. However, what I can do is it's growing at that 3 to 5% rate. I can borrow against it and it's still going to earn 3 to 5%. And when I borrow, I can go then use that to pay off my debt, right? So if it's making 3 to 5, my cost to borrow might be somewhere between 1 and 3. So let's say on average I'm making 4, my cost is 2. There's a 2% profit spread that I make on borrowing against my own life insurance policy. So when I have debt, what I will do is I'll fund policy, and then I'll line my debts up by balance size. I'll go smallest balance to largest balance, right? As soon as I've got enough money in that life insurance policy to pay off the smallest debt, I'm going to borrow against it. I'm going to pay that debt off completely, like one fell swoop and it's gone. The minimum payment that I used to make, I'm going to pay my policy loan back instead. So now I've taken my income, my debt to income ratio, I've lowered that, and I've increased my savings rate because that payment that used to go to a bank now goes to my bank. And so I'm actually building up savings with that instead. And then the money that I was using for this the whole time grew while I was using it like it never left. So if I go through this progressively, by the time I pay off the debt, I've handled all of it, it's gone. All of the payments I used to make are now converted to savings. And then the money that I used to pay off all that debt is still in the account growing like it never left. So I'm out of debt, my savings rate is skyrocketed, and I have more money than I started with at the end of this.
I think there's just so many interesting things about that strategy. I'm curious, why do you think most people don't know about this or maybe utilize it? Is it because it's hard to find an underwriter or an insurance company that will do that kind of policy?
Yeah, that's definitely one of the reasons. So there's a few of them. So the first one is the number one buyer and owner of these life insurance policies in the country are actually banks. So they're using this as their own reserve system. And so they're not going to sell it to others because others would then use that instead of the bank. So there's a lot of incentive, for the banks to use it and have it, but not for others to be able to find out about it. They would rather have people putting money in checking accounts and savings accounts and mutual funds. The second one is, the insurance companies, there are a few of them. There's about a dozen of them that can design it this way. And so that's also a factor. Is you got to find the right company, somebody that will design it correctly. And then the other part is the design itself. It's not an easy strategy from like an agent standpoint. If you're working with an insurance agent, it's not common knowledge on how to design these. When you put a policy together, an agent will make a commission. When they design it the way that I'm talking about, they take about a 300% pay cut because they're reducing their commission in order to increase the cash value, right? So if an individual agent is like in the business, they know about it, that's an ethical decision of, do I make less money to do the right thing? If the consumer doesn't know it's an option even, who's going to know? I just sell the more expensive one and don't tell people about this. From a sales management standpoint, there's not a sales office in the country that's going to teach their producers to sell something that makes less money for the company. So the insurance underwriters themselves, they're not one way or the other on it. They're going to design whatever you tell them to design. It's the sales offices, the agents that either don't know how to do it because there's not the financial incentive for them to learn it and to distribute it as a product, or they do know how to do it. They're just not willing to take that 300% pay cut. So those are some of the reasons and factors. When you dive into it, and you've probably seen a little bit now as you started looking at it, you start seeing it more and more. So there's little pockets and groups of people you can connect with, and they're using it. They know all about it, and it's like common knowledge. But for the general populace, it's not something that many people know about at all. If you're wondering, what does Wealth Dynamics do? How can we actually help you? Number one, if you haven't gotten a copy of my book, Blueprint to Financial Freedom, grab one now. You can get that down in the comments in the video. You can get the link for that. And finally, if you have a desire to start getting help walking through these different phases toward financial freedom, book a call with my team. Go to our website, set up a call. We're able to help out and answer questions. That's how we can help you. Thank you for watching. Like, share, subscribe. Make sure you turn notifications on, and I will talk to you guys on the next video.